The world is currently racing toward an energy demand cliff, and the accelerator pedal is definitely AI.
It's pretty staggering when you look at the numbers.
Yeah, absolutely. Just to put the scale of this problem into perspective for you, our sources point to a Bank of America report suggesting that by 2026, data centers alone, just the infrastructure fueling our modern digital life, could consume more electricity than the entire nation of Japan.
More than Japan. That's an astonishing amount of power.
It really is, and it creates this massive, immediate opportunity for reliable, carbon-free energy solutions, which, brings us right here.
Exactly.
This context brings us to one company that has absolutely exploded into visibility this year, Oklo, ticker OKLO.
Right?
Since its IPO via a SPAC merger back in 2024, the stock has gained over 550% year to date. I mean, it's one of the most talked about and maybe most scrutinized stocks in the entire energy sector right now.
And that scrutiny is crucial because, as you noted, the hype is just immense. Our mission today is really to cut through that hype. We have a company here with a market cap cited as high as, what, $20 billion? And it's currently pre-revenue operating at a loss. So this valuation, it's built entirely on the promise of future execution. We need to analyze the technical foundations, the cold, hard financial reality, and the aggressive management strategy.
Right, to figure out if this huge potential is justified or if investors are maybe just placing a really high-risk speculative bet.
Precisely.
Yeah.
Is the hype real?
Let's unpack this then, starting with the tech. The technical brilliance that's supposed to justify this price tag. Oklo's core offering isn't some massive traditional power plant. It's the Aurora Powerhouse Microreactor. Can you describe what this thing is and why its small scale is maybe such a game changer?
Sure. The Aurora Powerhouse is, well, it's a microreactor. It generates about 1.5 milliwatt, that's megawatts electric.
Which sounds tiny compared to a traditional plant.
It is tiny, but that's actually the point. They're inherently modular,
Yeah.
right? And scalable. You can chain them together for larger deployments, maybe getting anywhere from 15 up to 100 milliwatt.
Okay, so adaptable.
Exactly. This flexibility makes them ideal for, localized deployments, especially for things like data centers that need power quickly and often need it far from the existing grid.
And here's where it gets really interesting from what I've read. This isn't brand new, completely unproven technology. It's actually rooted in decades of nuclear history. That seems like a key differentiator.
That's absolutely right. The Aurora is a liquid metal-cooled, metal-fueled fast reactor design.
Okay, break that down. What does fast reactor mean for us?
Well, a fast reactor uses high-energy neutrons, which lets it run incredibly efficiently. And crucially, this design, it benefits from over 400 reactor years of operational experience worldwide. It's based on concepts proven by the Experimental Breeder Reactor 2, or EBR-2.
Ah, the EBR-2. That's famous for demonstrating inherent safety, right? That whole concept of being walk-away safe.
Exactly. That's really the cornerstone of Oklo's tech advantage. The EBR-2 tests, they demonstrated that the reactor had these inherent safety features. It was self-stabilizing, self-controlling.
So what happened in those tests?
Well, in those famous tests, even when operators simulated pretty severe accidents, like shutting off the coolant without engaging the shutdown systems.
Which sounds terrifying.
It does. But the reactor simply stabilized itself. No damage, no overheating. It just proves that the system inherently balances itself based on physics, making it fundamentally safer than, say, older designs.
That's powerful. Safety, speed, and scale. Okay, what about the fuel? Because that often seems like the most complicated part of the whole nuclear equation.
They seem to have a significant advantage there, too, in their fuel choice. They use metallic uranium fuel pellets.
And how's that different?
Well, these are denser, they're cheaper to fabricate, and more heat-tolerant than the standard ceramic uranium dioxide fuel that most, legacy plants use. But the real structural advantage comes from the fact that because it's a fast reactor,
Yes.
they're uniquely capable of using spent nuclear waste as fuel.
Wait, hang on. They can run on waste? How does that even work?
It's pretty revolutionary. The EBR-2 concept demonstrated that fast reactors can efficiently fission all sorts of fissile material, including used fuel from other power plants.
So they're actually doing this.
Oklo is currently working with the Idaho National Laboratory to take actual used fuel from the EBR-2 program and repurpose it for their very first Aurora powerhouse.
Wow.
Yeah, this is co-founder Jacob DeWitt's concept of turning waste into gigawatts. It gives them a potential long-term structural cost advantage and could bypass complex new fuel enrichment needs down the line.
Okay, so the technology sounds like the future. A genuine game changer. Small, inherently safe, fuel flexible, and this directly addresses that AI energy demand by offering reliable on-site carbon-free energy that potentially bypasses the grid interconnection mess.
Which can take years.
Right. Potentially cutting years off the deployment timeline for these power-hungry customers.
The technical foundation is undeniably compelling. You can see why the company is generating so much excitement.
But does Wall Street actually care about technical brilliance or just, cold, hard cash? Let's maybe slam the brakes right there and look at the financial reality, because this is where the picture gets, well, complicated, maybe terrifyingly complicated for some investors.
It really is the great tension with Oklo. According to the reported financials, this company is pre-revenue. It's operating at a substantial loss.
How substantial?
Well, they reported zero revenues in the early 2025 reports. During the March quarter, they had an operating loss of nearly $18 million, $17.9 million to be exact, and about $12.2 million in cash flowing out from operating activity.
Ouch. And they aren't expecting a revenue fix anytime soon, are they?
Not at all. Analysts are forecasting net losses around $66 million in 2025 and maybe $78 million in 2026.
And actual revenue?
First revenue isn't projected until their first reactors are deployed out at the Idaho National Laboratory site. And that's targeting late 2027, maybe early 2028.
Okay.
And even then, the projected revenue for 2027 is only about $13 million.
So if the company is losing money now and revenue is still years away, what does that massive valuation we mentioned earlier, that $10 billion, maybe even $20 billion market cap, what does that actually represent?
It represents pure, unadulterated future expectations. It's got almost nothing to do with current value. Let's talk jargon for just a second.
Go for it.
They trade at a trailing 12-month price-to-book ratio, or PB, near 67 times.
Okay, what's PB again?
It's the market price divided by the company's book value, basically. It's net tangible assets. The broader power industry averages around 5.58x. Oklo is trading over 10 times that average.
67 times book value. So the market is betting $67 on future hope for every $1 of actual assets they currently hold. That's steep.
It's incredibly steep. And to put an even sharper point on the speculation, some analysts calculate that this market valuation is more than 762 times the revenue they're expected to generate in 2027.
762 times revenue that's still 3 years away? That is astronomical. What on earth could possibly drive that kind of investor frenzy?
Well, a significant element you have to assume is the association with Sam Altman, the CEO of OpenAI.
Ah, the AI connection, right.
He previously served as Oklo's CEO and chairman, and he's still a top investor. That link to the whole AI demand story creates a really powerful narrative.
But narratives don't pay the bills.
Exactly. When analysts look purely at fundamentals, the stock currently carries a Zacks rank #4, which is a sell rating, precisely because the valuation is just completely disconnected from current financial performance.
Is there a comparison point? Another company, maybe?
Yeah, look at their competitor, NuScale. They're already generating meaningful revenue, about $37 million in 2024, and yet their market cap is only around $6.7 billion. Oklo is priced much higher, despite having zero sales right now.
Okay, so the company is, let's be frank, wildly overvalued based on current balance sheets. That brings us to management. They must have an incredibly aggressive strategy to even try and justify this colossal hype. How are they attempting to execute their way out of this valuation gap?
They are definitely executing aggressively on several fronts. First off, their business model. It's built for the long term and aims to create recurring revenue, which investors obviously like.
How so?
They plan to own and operate their powerhouses. They build it, they run it, and then they sell the power directly through long-term power purchase agreements, or PPAs. This takes the massive upfront capital cost away from the customer.
Okay, that sounds good in theory, but where's the proof they can actually convert customers? A pre-revenue company needs firm contracts, right?
They do. And they have demonstrated significant customer traction, at least according to them. They claim a 14 GW pipeline of customer interest.
14 gigawatts. That's huge. But pipeline interest isn't the same as signed deals.
True. It's likely a mix of letters of intent and maybe some firmer commitments. But they have secured strategic partnerships, notably with Vertiv, a big player in data center infrastructure, and also with the energy giant Liberty Energy. That helps validate their approach.
And crucially, they landed that contract with the U.S. government. That Alaskan-based contract feels like a major indicator of trust.
It's more than just a vote of confidence. It's really a validation of the core microreactor advantage. They won a contract with the U.S. Air Force to provide resilient, durable power to an Alaskan base. And this is seen as a multi-decade opportunity, maybe 20 to 30 years.
Why does the military love this system specifically? Is it just the small size?
It's the resilience we talked about earlier.
Yeah.
Think about it. A traditional power plant connects to a big, vulnerable grid.
Right.
A microreactor like Aurora provides power and heat or steam right there on site. It's completely independent, so the base becomes impervious to external attacks, cyber incidents, or natural disasters that might take down the regional grid.
Ah, makes sense for critical infrastructure.
Absolutely.
Yeah.
That capability is critical, and it's uniquely achievable with microreactors. Plus, they're also part of the Defense Innovation Unit's Advanced Nuclear Program, which could open doors to more installations later.
Okay, so government validation, key partnerships. What about physical milestones? Hitting targets for that first plant is key to justifying the stock price, surely. Are they on track?
Their signaling commitment, definitely. They had a physical groundbreaking event back on September 22nd, 2025 at the Idaho National Laboratory site. They brought in Kiewit, a huge contractor, as the lead. This reinforces that late 2027, early 2028 operational target.
So things are moving.
Things are moving. But the real potential competitive note, I think, is how they plan to leapfrog the regulatory barriers.
Yes, the Nuclear Regulatory Commission, the NRC. Infamous for being slow, complex, expensive, basically the graveyard of many promising nuclear projects in the past. How is Oklo planning to navigate that without sinking billions and decades into regulatory battles?
They are advocating for a completely new path, specifically something called the Performance-Based Licensing Methodology, or PBLM.
PBLM.
This is a crucial shift. For decades, the NRC had what are called prescriptive rules, meaning they told developers exactly which components, like specific pumps, specific pipes they had to use, mostly based on old light water reactor designs from the 70s.
So a rule book written for a different era of technology.
Pretty much. PBLM shifts the focus entirely. It looks at inherent safety features and functions. Instead of dictating parts, the NRC asks, does this system inherently shut down safely, regardless of specific component failures?
More outcome-focused.
Exactly. And they're using the DOE pathway for their first reactor at INL, which helps de-risk the execution and speeds up access to fuel. They believe this cooperation will help fast-track subsequent approvals needed for the full NRC license later on. This aggressive regulatory strategy is really key to reducing both risk and, crucially, the timeline.
And let's not forget that vertically integrated fuel supply strategy you mentioned earlier. That sounds huge, too.
That's potentially their ultimate structural advantage. It's got three parts. First, they secured 5 metric tons of HALU fuel. That's high-assay, low-enriched uranium from the DOE for the first plant, so starter fuel secured.
Okay.
Second, beyond that, the beauty of their fast reactor is its ability to potentially use down-blended government fuel stockpiles, including stuff like plutonium-based materials. This could bypass the expensive, time-consuming HALU enrichment process for future plants.
Avoiding a major bottleneck.
A huge one. And third, their planned recycling facility in Tennessee to actually reuse spent fuel that kind of seals the deal. Could create a massive structural cost and supply advantage for the long term.
So, okay, we have a phenomenal story here. An undeniable market tailwind in AI, technically proven next-gen tech, and this aggressive management strategy focusing on speeding past regulatory and fuel hurdles. But that stock price is already priced for perfection, as we discussed. What is Wall Street saying now, after this huge run-up?
Well, the analyst consensus is, maybe unsurprisingly, pretty mixed. It's a perfect reflection of this high-risk scenario. Overall, the rating is currently a moderate buy. That's based on 14 recent analyst ratings. 6 buys, 7 holds, and 1 sell.
Moderate buy, but with caveats.
Big time. What's fascinating here is that we saw a significant shift in sentiment just recently, in September 2025. Multiple prominent firms like Mizuho and Seaport Global actually downgraded the stock to hold after that massive price appreciation.
Why?
They basically recognized that the stock had run too far, too fast, based on fundamentals. The narrative got ahead of the reality, at least for now.
That huge internal disagreement among analysts must result in a pretty insane price target range then.
Oh, it does. The volatility is baked right into the projections. The average 12-month price target right now is around $79.75.
Wait, if the stock is currently trading around $110, that average target actually represents significant downside.
It does, but the spread is truly staggering. The high target is $150 at some Wedbush, and the low target is a shocking $14 from Exane BNP Paribas.
$14. From $150 down to $14. That's almost a 90% difference. That spread alone is a streaming indication that analysts fundamentally disagree on whether this company will even exist in its current form in a couple of years, or if it's going to completely revolutionize energy.
It absolutely showcases that investors are not buying current earnings. They are purely pricing in the probability of future success. This is a classic high-risk, high-reward proposition. The entire outcome hinges on flawless execution and avoiding any delays in regulatory approvals or construction timelines. Any stumble will likely be punished, and punished severely.
Okay.
So wrapping up this deep dive, the hype for Oklo, it's built on massive market potential. That modular reactor market could be worth $1 trillion by 2050, and they definitely have a compelling technological foundation rooted in that EBR2 heritage and a truly superior fuel cycle strategy. But the justification for that multi-billion-dollar valuation rests entirely on two things. First, successfully converting that claimed 14 GW pipeline of customer interest into real, bankable power purchase agreements. And second, successfully navigating those novel NRC and DOE regulatory pathways on time to hit that late 2027 operational target.
The financial risk with that pre-revenue status and the, frankly, eye-watering 67x price-to-book ratio is crystal clear for any fundamental investor right now. But as you said, so are the strategic advantages they've built, that potentially unprecedented fuel access through government partnership, and the unique ability to offer resilient on-site deployment that bypasses the grid entirely. That really meets the urgent needs of the AI revolution head-on.
And this leaves us with a final provocative thought for you, the listener, to consider. The sources we looked at highlight that executive orders were issued recently, specifically directing the NRC to streamline its advanced reactor licensing review down to a target of just 18 months.
18 months. That's fast for the NRC.
Yeah, it's extremely fast. And Oklo's entire licensing strategy, that performance-based licensing methodology, is designed precisely to capitalize on regulatory speed. So the question is, if Oklo and maybe similar advanced reactor companies actually manage to compress their timeline to commissioning significantly faster than their established traditional multi-billion-dollar counterparts, does that regulatory speed become the ultimate wild card? Could it accelerate the entire AI energy transition and fundamentally reshape the competitive landscape faster than anyone currently expects?
A fascinating question, and definitely something worth keeping track of as they approach that late 2027 deadline. That was a great deep dive into Oklo.
Indeed, a lot to watch.
We'll see you next time.